Today, I'm going to give you 3 of the biggest tax mistakes I see folks make in retirement, as well as some tips on how you can avoid them. The tax code in our country is ridiculous, and not ridiculous in a good way. Here's the thing, it gets even more ridiculous when you retire. While you're working, for the most part, it's about earned income and deductions, ways that you can reduce that income and therefore lower your tax bill. When you retire, your income comes from different sources and they're all taxed differently. So tip number 1 is avoiding the Social Security tax torpedo. That sounds really ominous. The tax torpedo. I picture this torpedo cruising under the water toward your retirement boat, just gonna crush it and sink it. And the truth is, it's not actually much better than that in reality. Here's what it is. Back in 1984, Social Security benefits became eligible to be taxed. This was done to raise revenue and help Social Security remain solvent. Does that sound familiar? At least for the time being, it worked. They did this by creating something called provisional income, which is basically your modified adjusted gross income plus non-taxable interest plus 50% of the value of your Social Security benefits. Now, it gets a little bit tricky, so I'll pop this up on screen and you can follow along as I go through it. The threshold for this income, provisional income, was $25,000 for single filers and $32,000 of income for joint filers. If you were above that point, 50% of your Social Security benefit becomes subject to tax. But they didn't stop there. They went back to the cookie jar. In 1993, Congress added another layer of tax with thresholds of $34,000 for single filers and $44,000 for married filing joint. At the higher income levels, you're now subject to 85% of your Social Security benefit being taxed. Here's the worst part. They did not index those amounts for inflation. Those figures, the dollar amounts I just gave you, are the same as they were 31 years ago, which essentially means that every year more and more people are subject to this tax as the value of things like required minimum distributions and Social Security benefits rise. Now here's where it hits you. If you pass over from, say, the lower threshold into the higher, that extra bit of income results in an extra 35% of your Social Security benefits becoming taxable. That can completely blow out the effective tax rate that you're paying on your money by triggering tax on so much more of your Social Security benefits. It's pretty involved. Honestly, might put you to sleep if I went through all of it. So maybe at some point I'll do a tax torpedo video for people who are interested in that, and I'll break down an example. But for right now, be aware if you're receiving Social Security benefits and you have other sources of income, whether that's earned income from working or traditional IRA or 401k distributions, you need to be working with someone to plan for this sort of thing. Now, as for how to avoid it altogether, a couple of things come to mind. First off, Roth distributions do not trigger provisional income. So imagine that they're a great source of retirement income. If you're getting close to triggering the additional tax, if you're getting close to being hit by the torpedo and you need extra money, drawing from your Roth account in that year can be smart because it won't add to your provisional income. Another potential out is to delay taking Social Security when you first retire. Draw your income from tax-deferred accounts, which can lower the future distributions you're going to have to make once you do turn on Social Security. Hey, while you're watching the video, check out the description. I've got links down there to some of our best stuff, some of our free guides to Social Security, to creating retirement income. You can also book a call with me directly if you've got questions about planning your own retirement. Now let's move on to tax mistake number 2. This one's pretty straightforward. It's proactively managing your gains and losses on non-retirement assets. Specifically, we're going to talk about tax gain harvesting. Might be something you haven't heard of before. The mistake here is that almost no one does this, and if it applies to you, you should absolutely look at doing it. Under the tax code, you can have a certain amount of long-term capital gains that are tax-free depending upon your income level. So in 2024, you can have taxable income of $47,025 as a single filer or up to $94,050 married filing joint, and you're going to pay 0% on your long-term capital gains. Beyond that level, it's either going to go to 15% or 20%. So here's the missed opportunity. If you have stocks in particular that you've held for a long time and they've got large amounts of appreciation, the stock price has gone up over the years, you can sell part or all of that stock to realize the gains, and you might be able to do it in a tax-free manner if your income is below the thresholds I just talked about. So let's say that years ago you bought some stock and it's gone way up and you got $50,000, $100,000 or more in deferred gains, and you're worried about cashing it in because you're going to pay a lot of taxes. Well, deciding to sell some or all of that stock specifically to realize the gains, depending upon your income level, is a great strategy that almost nobody talks about. Now, if you really like the stock, You can go on back later and buy it again if you want to continue to own it, but choosing when to realize some of those gains, especially if you have a year where you're going to be in that 0% tax rate, can make a huge difference in the long run. As for the third tax mistake, I'm going to lump a few things together here, and I'm going to call it not managing your tax legacy. What I mean here is this: when you pass away, if you've got money left over, it's going to go to one of three places. Your beneficiaries, think your kids, your grandkids. It might go to a charity if you've decided to leave some money to charity, or it's going to go to the IRS. That's it. Every last dollar that you have that's left when you pass on is going to one of those three places. Managing your tax legacy is doing some planning in advance to maximize the amount of dollars that go to the first place and the second place, and minimize the amount of dollars that go to the third place. Now, there are more topics here than can fit in one video, but briefly, I'm going to try to give you two examples. The first one is income planning if you pass away and your spouse remains. So losing the marital deduction, as well as losing the smaller Social Security check for a lot of retirees, means that to keep a similar amount of income coming in will mean paying far more in taxes. I'll give you an example. Let's say that we've got Bob and Jane, and they're both retired, and they've been retired for a little while, and they've got $1.2 million in to-be-taxed traditional IRA money. They got $200,000 cash in the bank, and they get Social Security checks of $4,500. $3,100 a month for Bob, $1,400 a month for Jane. Now, let's say that they need $7,000 a month in income, $84,000 a year to live. This is a very sustainable scenario, and most people would look at that and they'd say, hey, they've got well over $1 million. They only need $2,500 a month. They don't have any problems. And then Bob passes away. What happens? Well, for starters, the Social Security is cut by $1,400 a month. So now Jane's got to draw more money from that IRA or 401k to cover the living expenses. Here's the real hit, though. While she may not be at risk of running out of money, she's now filing as a single filer. She's no longer filing a joint return with Bob. So three things have happened here that have changed her situation. One, she lost some tax-preferred income because of the disappearing Social Security. Two, she has to take a larger distribution from a to-be-taxed account to make up for that and maintain her income level. And three, she went from filing jointly and getting a $30,000 or so standard deduction every year to getting one that's less than $15,000 as a single filer. So from a tax standpoint, the makeup of her income got worse, her taxable distributions went up, and her deductions went down. All of those things cause her effective tax rate for the same amount of money to go from paying $1,632.50 in federal income tax to paying $8,566 in taxes. That's a 524% tax increase for the same amount of income because of those three things that happen. And that scenario is likely to repeat itself basically every year as long as she's around. The long-term impact of that to somebody can be tens, even hundreds of thousands of dollars of your money that is lost to taxes. Planning ahead for this kind of stuff, diversifying your retirement income streams, and going through a tax planning process can have a major impact on how much of your money you get to keep. Now, I was going to give a second example of another tax legacy idea, but I went on a little bit long there. I like this stuff. I get to talking about it. Sometimes I don't stop. So I'm going to save that for another video. While you're continuing to learn about retirement planning here on YouTube, go ahead and check out our latest video right here.